multiple microphones here, and unfortunately, I think I'm going to be using the one that is attached to my Bloomberg keyboard, which is not the best one because I've got a whole bunch of other ones here that go for CNBC. But there's a lot of equipment in this room, and I'm not the expert on that. So I'm going to just make sure that you guys can hear me. So thanks so much for having me. I really appreciate being here.
No problem, Mike. No problem.
Hey, so this being the first time that I've joined all of you guys. I would normally, if I was giving a keynote in a big room, which I usually appreciate, I prefer to talk to a big crowd because then I can get some interaction, I can see what's going on, and I can ask a question. For example, how many of you have traded options? Given the background of Cyber Trading University, my expectation is that most of you have some experience with them. But I thought I would sort of give a little bit of a background here, and then we would talk about maybe a different way to approach it, using them for signals and insights. And then, of course, I'm going to be very happy to take some of your questions on any option strategies or anything else, frankly, that you have questions about. So this is a 20-year history that you're looking at right now of equity trading volumes in the United States. And as you can see, equity trading volumes really haven't done a great deal. On the other hand, options trading volume has exploded. So clearly there's a real interest in the product, in its uses. And this does something kind of interesting other than grow at the pace of the US debt, which is what I have here. It's kind of interesting that the orders of magnitude of growth over the last 20 years in options trading volumes in the United States is about the same as that in the growth of the US debt. But what I'm really interested in sharing with you guys today is how you can use options to identify hidden catalysts, to watch potentially for shifts in sentiment in stocks, to look for situations where you can get asymmetric payoffs. You know, one of the most important things as an investor and as a trader is don't lose money, or to set yourself up into positions where what you can make may exceed what you can potentially lose. So if you have a coin toss, but you can make more when you get it right than you lose when you get it wrong, that can be obviously very good. It can be as good or better than having trades that are high probability. And then finally, I wanted to talk a little bit about embedded options. And the embedded options element really is going to be about MicroStrategy, because Michael Saylor is, you know, right now probably one of the biggest options traders there is. And we're going to talk a little bit about what it is that he's doing and how he's creating some accretive effects for his shareholders using options. So quick background. For those of you who don't know, but we're just going to refresh everybody's memory, a call option entitles the holder of that option the right to purchase an underlying asset at a predetermined price on or by some future expiration date. So that underlying asset, of course, could be a stock, it could be a physical asset, it could be commodities, it could be futures, it could be whatever. Put option is essentially the opposite, gives the holder the right to sell an underlying asset at a predetermined price on or by some future date. Now, options have been around for a very, very long time. And the earliest documented use of options was about 2,650 years ago by this guy, Thales of Miletus. He was a Greek philosopher. He lived and died in what's now modern-day Turkey. And he did not have a great deal of money, but he was a very intelligent and insightful person. He's one of the founders of modern science, in fact. And
hey, Mike, just cut you off. Are you sharing your screen?
Oh, I am. Yes.
You're not seeing. I'm sorry.
Okay. So let's just. I'm glad you mentioned that. That would have been. There we are. So
there we go. Okay.
So you haven't seen any of these slides, then?
No, it's
That's
fine.
not very helpful. So let's just go. I'm just going to quickly show you. So equity volume flat, and options volume has exploded. about the same pace as the U.S. debt has grown. So this guy was the first known and documented trader of options. This is a guy who actually Herodotus documented, among others. And what this guy did was he didn't have a lot of capital, but he recognized the patterns that were going on in the climate where he lived, and he saw that it was very likely that there was going to be a very good olive harvest that particular growing season. He didn't have massive olive groves, and he also didn't own olive presses, which of course is what's necessary to convert those olives into olive oil. This is a bit of what they might have looked like back then. So this is what actually crushes the olives, and these are the olive presses. And you can see that there's a few of them. When you talk about first press olive oil, you can see there's 3 here. That's the most valuable olive oil there is. But as you can see by the nature of these devices, this is also not something that you're able to construct very quickly either. And Thaler's theory at the time was, if there's going to be a lot of olives, there's going to be a lot of demand for olive presses. And with the limited amount of capital that he had, he went to the owners of the respective olive presses and asked them how much it would be to rent those presses. And they gave their prevailing price. Now, at the time, this was before the harvest, they had some rate that they expected they would charge. And he said, if I pay you a small amount of money now, will you commit to renting me your presses when the harvest comes at the price we just agreed to? And he did this all over the region. And as you might imagine, when the olive harvest was a bountiful crop and the demand for these presses skyrocketed, he made his fortune. And this is actually one of the first things that people who trade options are usually looking to do. They're trying to capitalize on the leverage that an option can provide. Now, what we're looking at right here is just a screenshot from my Bloomberg terminal. This is how the XLP, which is the Staples ETF, has done this year. Olive oil being a staple 2,650 years ago. These are our modern day staples now. And we can see that had you bought XLP at the beginning of the year, and this isn't actually a graph of the total return, this is just the price of the ETF. There's a dividend as well, so your total return would have been a little bit higher. But as you can see, you would have gained probably in total return terms something in the neighborhood of 16 to 18% for the year. Not bad for a long-term investor who's a retiree maybe, but for those who are trading, that's not quite cutting it. Had you simply bought an at-the-money call option that expired 1 year later, this is what you would have returned. Now, you'll notice I drew a little arrow at the end of this. The reason being that options don't necessarily trade quite as regularly. This is just a chart of the last prices of those options. And I had to draw that arrow to indicate where the value of that call is today, because it's actually deeply in the money. Now, if you're trading options, that's not what you would have done. You wouldn't have bought a call option that expired in a year and then waited for XLP to sort of go up a little bit. And a little bit and a little bit and hold on to it and not adjust it. But even had you done that, which isn't the best way to do it, you can see that you actually would have made a multiple of your money. This thing was less than $4 at the beginning of the period, and it's worth in excess of $9 now. So you would have done 2.5 times your money. And that's oftentimes what draws people into trading options in the first place. What they're interested in is this idea of leverage. But remember what I mentioned earlier, which is that one of the things that matters most in trading or investing, no matter what it is you trade in or invest in, is minimizing your losses, and chasing leverage isn't necessarily the best way to do that. What I'm looking at right now, what you should be seeing, is a chart of Federal Express. And incidentally, I have to apologize. I'm using these really low res. I didn't know what everybody would be able to see. So there's no candle charts in here. I just basically am using simple line charts blown up for illustrative purposes. And if we're going to try to take a look at some things in a moment, we can get a little bit more specific. This is a price chart for Federal Express over the course of the last year. And on here, you can see some little blue squares. And what those blue squares are, you can probably guess already. Every publicly traded company in the United States has to report their earnings every quarter. And that is what is designated by those little squares. So one of the things we can see about the way stocks behave is that they are much more volatile around specific catalysts than they are the rest of the time. So you can see that Federal Express essentially is trading sideways, or it gets into downtrends or uptrends. We can see that it was sideways after the first quarterly earnings report that we have here in December of last year. We can see that the stock skyrocketed and then was in a downward trend for an extended period until the next quarter. And then we had another sideways period. It plummeted and it rallied and so on. Now, when it comes to options, this is a very important dynamic, because if you're going to own options, clearly you'd be much more interested in owning them in and around the times that stocks are poised to move, and not so much when they're not moving. So the first sort of lesson I would provide, and I heard this in the first talk, that if you believe something's going to move, you're interested in buying call spreads if it's to the upside, buying put spreads if it's going to be to the downside. But there are other periods when you should be focused principally on looking for income. And if you can identify catalysts, then that's a good place to start about when strategies like this might be appropriate. I have a good friend of mine who is also a longtime former market maker. His name is Matt Amberson. He runs a company called Options Research and Trading Services. And he and his team have done extensive quantitative research, and they've also done a lot of research on options overwriting strategies. And one of the things they identified was that in general, it does not make sense to sell covered calls, for example, going into earnings. This right here kind of reveals the reason. You can imagine that if you sold a covered call and the stock plummeted, the amount of premium that you collected from selling that call is going to be de minimis, and you would have taken most of the loss of the stock's decline. And if you did it the next period and the stock skyrocketed, you would have sacrificed most of the gains. And this is not going to be, in the long term, a successful strategy. So options traders aren't idiots, the market makers. I worked at a quantitative market making firm. We typically employ a lot of quantitative analysts. Kids from MIT and places like that are chewing on the numbers. And consequently, options prices are going to reflect that dynamic. And what you're looking at here is the volatility surface. This is effectively the price of options. You can see going out in time and across all of the strikes. If you're looking at the bottom axis on the left, this is a three-dimensional chart that goes from 80% to 120%. That represents the strikes in Federal Express. And I took this screenshot yesterday, right after the close. So this is Federal Express. And you can see this red region really pronounced and elevated options prices for next week, December 20th. Why is that? It's because Federal Express is going to be reporting earnings next week. And as we saw in this chart, when they report, they move. And options prices reflect that here. So this gets me back to how we can start thinking about using options prices as a way to detect potential market moving events that are not on the calendar. We all know when earnings are going to come out. The companies have to report it. It's going to be on their investor relations website. If you have a Bloomberg terminal, it's going to show up there. If you use TradeStation, you use Interactive Brokers, whatever platform you use, this information is going to be revealed to you. So it's not really going to be much of a surprise to anybody. So why don't we just go back to staples for a second, which we were talking about after we talked about Thales. And this is a list of the largest constituents of the XLP, the staples ETF. There's something we can see here. And that is that this is mostly Coke and candy, right? So soda, candy, cigarettes. Eat a lot of this stuff, you gain a lot of weight. And if you gain a lot of weight, you want to do something about it. And of course, this year in particular, we've probably spoken about this more than any year prior that I can remember, but we finally appear to have some drugs on the market from Novo Nordisk and from Lilly, semaglutide and tirzepatide, that appear to be, and who knows, if you can see a picture of me, you probably realize I should probably take an injection or two of this stuff. But this is a profound change for American weight loss. And earlier this week, I happened to be looking at this company. Now, if you don't know what this chart is, this is Hims and Hers Health. Hims and Hers Health operates an online website where they sell all kinds of stuff. Basically everything that ails you. You need to lose weight, you need to regrow your hair, you need to tackle your anxiety, you have to have better sex and all the rest of it. Hims has got the answer. So one of the things you're going to notice here in the lower left-hand corner is that they are selling GLP-1s, lose weight with GLP-1s. And you're going to see, if you can make this out, that on that little vial, it says compounded semaglutide. So looking at that chart, that's this one, which is a stock that's obviously had a profound year. This was through yesterday. I was just taking a look at it. The first thing I do with almost every stock is I go and I take a look at the volatility surface. And here it is. Looks a lot like Federal Express. But here's the thing. Hims is not reporting earnings. They reported earnings in early November. And they're not scheduled to report again until next year. In fact, when I looked at their investor relations website, I couldn't see anything specifically on the horizon. But the volatility surface told me something's going on here. Now, this surface had a little bit of a bump in it on December 6th. It had a much bigger bump in it on December 9th that grew even more by December 10th. What was going on? Clearly, something is going to happen in this company, but it's not on the calendar. And so I spent probably the better part of a couple hours trying to figure out what this could be. Somebody knows something. I can see it right here. What is it? Well, what I learned was, and this kind of goes back to that compounded semaglutide. Novo Nordisk and Lilly are up a lot. And the reason they're up a lot is because they've developed these drugs. And as most of you will know, when a company develops new drugs, they basically have the rights to produce it until such time as they lose their protections and others can compound it. And yet Hims is already selling it. So what was going on here? Well, what's going on is that these drugs are really important for the health of Americans. And what's going on is that the FDA said that there's actually a shortage of these drugs, and these drugs are considered critical. And something interesting happens when a drug is officially on the FDA's shortage list, and it's considered to be critical to essentially the health of the nation. The FDA will then say that compounding pharmaceutical companies can sell effectively generic versions. And that is what Hims was doing. That is the reason why Hims and Hers Health is up multi-fold so far this year, because they are actually able to compound GLP-1 drugs and sell them on their website while it is in shortage. And in early October of this year, the FDA decided that Lilly and Novo were able to produce enough of these themselves, and they took these drugs off the shortage list. Hims and Hers sued, and they sued in the Northern District in Texas, and the court there ruled that they were going to remand the decision back to the FDA. And if you look at this, this is one of the things I uncovered at the time, you can see that they were going to respond no later than December 19th of this year. So that is what's going on. The reason we saw that big bump in the vol surface was because the FDA was going to make a determination about whether or not they were going to keep this on the shortage list. Whether they did or did not, that was going to impact whether Hims and Hers was going to be able to continue to compound this drug. And that is the whole reason that stock was up. So all you had to do if you were looking at that stock was say, let me just keep an eye on the vol surface. And then once you see that vol surface popping up like that, you know something's going on. You know, there was a book that was written called The Wisdom of Crowds. And in it, it had to do with some folks going to a fair a little over 100 years ago. And they asked the crowd to take their best guess at the weight of an ox. And one of the things they found was that even though there were real experts there, butchers, farmers, and so on, that the average guess of the entire crowd was better than the best guesses of all of the professionals. There is wisdom in crowds. Well, as options volumes have exploded, there is more information about what people believe the future will hold embedded in options prices, and those are all real money votes. In other words, options prices reflect the bets that all of the informed market participants who are willing to commit their own capital to bet on the future are making about the price behavior of the underlying asset. Okay, let's move on to another place where we can look for potential indications. This is a chart of GoPro. And I actually wrote an article about this at the time. This was about half a year after GoPro IPO'd. And you can see obviously that the stock absolutely took off. This was not an immensely profitable company at the time. The last date that you can see there is October 1st of 2014. Stock was trading around 91.80. And on that day, I happened to take a look at the options prices. And what I saw was that the January 90 calls were about $10. I could buy them for $10. And the January 90 puts, so I'm not talking about January 2016. I'm talking about the options that were only 3 months away. The January 90 puts were nearly $25. So if you're looking at that and if that doesn't immediately set off an alarm bell for you, I want you to think about something for a moment, which is that means that on October 1st, you could have bought the stock for $91.80, or you could have bought the January 90 calls for $10, sold the January 90 puts for, call it, $24, and you would have owned the stock forward at $76 a share, a big discount to the current stock price. Now, why is this true? Well, you can imagine that if you own the 90 calls and the stock is above $90, you will exercise your calls. They'll probably be exercised automatically, and you'll purchase the share at 90. But remember, you bought the calls for 10, you sold the puts for 24, so you actually collected $14 at the time. Your effective purchase price is going to be $76 a share. Now, let's imagine something different happens. Let's imagine that the stock fell. Well, if the stock falls to $70, your calls are out of the money, nothing happens. You're short the puts. You will be assigned. You will be forced to buy the stock at $90 a share, but net of the $14 collected, you paid $76 a share. So the forward price is $76. If you are long the call, short the put, same strike, same expiration, that's a synthetic long position in the stock. And you want to pay attention to those and compare them to the current prices of the stock, because when you see something like that, the options market's telling you something really important. Now, in this case, and it probably isn't going to surprise experienced traders in this crowd to know, this stock was very hard to borrow. But that was a real warning sign. At the very least, even if you loved GoPro, you shouldn't have bought the stock. You should have traded it synthetically with options. But of course, the truth is that was really sending you a signal. And that signal was, watch out below. That red arrow points to where $76 was on January expiration. And you can see that the stock fell significantly more than that. So now we've got two examples of how you haven't even traded options. All you did was look at their prices in a very simple way and glean something about how the underlying stock might behave in the very near future. All right. NVIDIA. There's a good chance you guys have heard of this company. In the Bay Area where I live, there's a number of people who have worked for this business, and they have done exceptionally well. And one of the things that I have been tasked with on occasion is talking to some of the families whose family members worked at this company. I'm not going to reveal a whole lot more than that, but let's just say that a lot of these families have done exceptionally well. A lot of these people still believe in the company. They want to stay long, or they just don't want to sell because they don't want to incur the tax consequences. And in a state like California, that can be particularly onerous because California does not have the concept of capital gains tax or long-term capital gains. So capital gains are taxed as income here. That is a real problem. So you want to hold on to your stock, but it has had an explosive run in the last couple of years, and you want to protect some of your gains. Well, this position right here is what the P&L would look like if you collared your NVIDIA out to January of 2027 using a 130 200 collar. Now you're going to notice this little line that goes up and down in the middle. That's the break even. You can get this payoff if you happen to own NVIDIA right now and you've got it as a long-term hold. You can get a payoff that looks like this simply by collaring your stock. Now, why is that? This wouldn't have been true only a couple of years ago. Well, what has happened recently, and this is why you can't really just set up a single set and forget rule. Collaring stock isn't always going to give you these kinds of asymmetric payoffs, but they do when certain things happen. And what has happened also goes to this forward price that I was talking about in GoPro. In that case, there was a big short shorting costs. Essentially, the borrow cost on that stock, because it was hard or almost impossible to borrow, was immense. In this particular case, we have seen something we haven't seen for a long time. We've seen interest rates go up. As interest rates go up, the forwards go up. And as the forwards go up, the value of calls goes up relative to the value of puts. Now, this isn't an arbitrage, because if you are going to go out and buy NVIDIA and then put on a collar like this, you are committing a certain amount of capital to that, and that capital cannot be used to earn returns elsewhere. So this is no arbitrage. But it does point to the fact that this isn't completely zero sum, because you have market participants who are in underlying assets for very specific reasons. Like you worked at NVIDIA, you got a lot of employee stock grants, you don't want to sell it. You're not going to convert this stock into anything but NVIDIA stock. The only thing you can do is look for options trades that can help you protect the immense gains that you've had. And here you can do that and do it at a very favorable level. Now, the interesting thing, of course, for those people, and if you happen to be among them, some of you probably are. There's probably a couple people in this audience right now who bought NVIDIA. I know somebody who bought NVIDIA by accident. He was opening up a self-directed brokerage account. They said, if you deposit a couple $100, we will give you a couple $100. And he opened it up, used that couple $100 to buy NVIDIA. This was years and years ago, and he forgot all about it. And then one day, he had moved, he'd gotten remarried, thing shows up in the mail, what about your lost account? Oh yeah, he had bought some NVIDIA shares. Yeah, those NVIDIA shares are now worth $110,000. He'd only put a few $100 into it to begin with. Well, trade like this might make a lot of sense for him. All right, so before I get to taking any questions, because I definitely want to leave some time for that, I want to talk about this guy right here. Now, this was before I recognized that this probably wasn't going to show up that well on your screen, so this does have candle charts. This is MicroStrategy. And this is where I'm going to talk a little bit about embedded options, because MicroStrategy basically is options. That's what this stock is. It's options on Bitcoin. Now, what's going on here? Michael Saylor, I think, he really he had an epiphany. And what he is doing, as many of you will know, and there's a lot more to this, but I'm just going to focus on the simplest elements of it. What he's been doing is he is selling zero coupon convertible bonds. Actually, there's some very low interest converts as well. What is a convertible bond? Well, it is a bond with a call option attached to it that converts into the underlying equity, in this case, MicroStrategy, at some conversion price. I think his most recent issuance has a conversion price, and then we can probably look this up when I cancel this PowerPoint, and we can just look into the terminal and see. But I think the conversion price is something around 630. He is borrowing that money at no interest. He takes that money and he buys Bitcoin with it. And because the conversion price is substantially higher than the current stock price, every time he does that, it is accretive to MicroStrategy shareholders. And the reason he can do that is because the volatility. Remember at the beginning of this whole talk, what I was talking about was this very high implied volatility. Bitcoin is a high volatility asset. And these are not options on Bitcoin. These are options on MicroStrategy. MicroStrategy is levered because he is borrowing money to buy Bitcoin. So the volatility of those converts is much, much greater. The value of that embedded call option is enormous. And consequently, he can do things like that. He can sell 3-4 year converts with strike prices that are 20, 30, 50% away from the current stock price. Now, it's kind of hard to say exactly what it is because the stock price is moving around so violently. It was $540 not that long ago, close to 400 yesterday, and I'm not even sure exactly where it is right now. But that's the dynamic that's going on. But there's something else that's important to remember too, that if you buy MicroStrategy, you are buying a basket of options. He has a levered bet on Bitcoin. And what is also interesting is that the more he puts on this levered bet, the more levered his business becomes, the higher the volatility of the equity becomes, the more valuable the call options are that he will be selling on those converts going forward, and the more he can do this, and so on and so on. And if this sounds too good to be true, well, this will work until or unless or if Bitcoin falls precipitously. And it would have to fall quite a lot. But the fact is, MicroStrategy still owes that money back. One other quick point about these converts, which I think is just brilliant, and that is that if you are a fixed income manager and you are trying to contend with something like inflation, and you see an asset like this and think a small amount of this would do wonders for my portfolio, and you're right, but you can't buy it because the fixed income manager cannot buy Bitcoin. They can't buy an ETF like IBIT, which is essentially an equity-like product. They are supposed to invest in bonds. Well, a convert is a bond. So in addition to sort of taking advantage of the high volatility dynamic and building on it, the other thing that Michael Saylor has done is he has tapped into a big institutional investor class, the largest actually, and given them exposure. And to put things in perspective on how profound the impact of this could be on a fixed income manager's investment performance, you can take a look at something like HYG, which is probably the best known high yield. We sometimes call them junk fund ETFs, or HYLB, which is the one that was issued by DWS. Actually, a friend of mine who runs fixed income at the Employee Retirement System of Texas sponsored that. You will see that the total return for a decent high yield manager this year might be something in the neighborhood of 800 basis points, 8%. Had you allocated 1% of that portfolio to the 2027 zero coupon converts in MicroStrategy, that would have added 200 basis points to your performance. That would have taken a fixed income manager who made 8% in total returns from December of last year to present up to 10. So that would take you from your benchmark, which is hard enough for managers to hit net of expenses, believe me, to one of the best performing in the entire space by a long shot. So what I'm hoping we manage to get to here is that you have some things to look at that will help you inform about the potential price action of the underlying assets. There's a lot to unpack when it comes to options. It's a very deep and rich area, and we're sort of scratching the surface of it. But there is one thing I wanted to leave you with. Now, I'm sure many of you have heard this quote: "Give a man a fish, and he'll be hungry again tomorrow. Teach him to fish, and he'll be richer all his life." Yeah, that's all true, but I want to remind you, be careful of the size of the fish you go after. And this goes back to the first reason why people get into options in the first place. They usually are attracted to them by leverage. And if that's what draws you in, that is what's going to carry you out. I promise. Look for small wins, look for singles, look for doubles, look for signals, but don't screw around with thinking, oh, this chart looks brilliant. I'm going to plow 10, 15, 20% of my capital into long bets using out of the money call options. If you make bets where something has to happen for you to preserve your capital, you're probably going to find yourself in bad shape. And I learned this lesson quite painfully myself, not in the publicly traded markets, but in my foray into the private markets. So I've done a little venture investing, going into ideas that I thought were absolutely brilliant. And of course, if you have a little bit of success in the publicly traded markets, then you probably think you know a lot about a lot of things. It's not always true, but I have committed more capital than I should have to ventures that didn't deserve it and paid a painful price for it. So the best lesson I can leave for you before we get to any questions is great instruments to trade, use them to your advantage. Don't go after the biggest fish you can find.
Well, Mike, thank you so much. And yeah, we had a lot of questions for you. And, some of them came across here, and I got a bunch of questions for you too. Listen, the audience that I was here, I mean, there's a lot of traders here, are day traders. A lot of them starting to realize that they're doing some of the options. I mean, when I saw you, we spoke a lot about crypto. I mean, at the summit we were at, I mean, that was a big event, and we saw how it was testing 100. But some of the things that I want to ask you with your experience is that what is the most memorable trading that you ever made that you learned from? Because there's a lot of traders in here. We always learn from our mistakes. Like, one of the big things I always teach my students is not how to make money, is how to stop losing it. I know we spoke about that, but what is the most memorable thing you could share with everyone here that you have probably learned, and that you could, hopefully someone doesn't do the same mistake?
Boy, over 25 years, there's so many big ones. There's so many big ones. So I think I'll highlight three. And some of these are actually, they're events that are big enough that people who are watching, if you were around for it, you will have remembered it. So I guess it would have been around 1999 or 2000. Among the names that I traded at that time was a company called Tyco International. And I don't know if you remember Tyco International. Tyco International, and it's not the toy company. Tyco was basically a company that was attempting to replicate the success that General Electric had as a conglomerate. So they had a company, and their whole idea was that they would buy other companies that were trading at multiples smaller than their own. And that was, of course, accretive, kind of like what Michael Saylor's doing. Anything that corporate management can do that's accretive. You have $1 billion company, it trades at 30 times earnings, and you find a $500 million company that's trading at 20 times earnings, and you buy that company with your own stock, and suddenly you create $250 million in enterprise value, because that 500 million portion of that business is now trading at your 30 times multiple, and you do this again and again and again. Now, the guys that ran this company, the CFO at the time was a guy named Mark Schwartz. The CEO was a guy named Dennis Kozlowski. And Dennis Kozlowski got pretty famous. And one of the reasons he got famous was because, well, first of all, he had a $2 million birthday party for his wife, and he had ice sculptures that had frozen statues urinating vodka into stuff. It was a crazy excess. This was nowadays, of course, with tech cajillionaires, these things probably don't seem that big. He bought a 120-foot J-class America's Cup racing boat from the 1920s. He was spending money all over Nantucket. He was buying apartments in New York. He was big at the art auctions in New York City. And I didn't know this, but while we were making markets in this thing, one of the things he was doing was also he was buying some of that artwork and having it shipped to their offices in New Hampshire, supposedly so he could avoid the sales tax. And what he was actually doing was shipping empty boxes up there and just having the paintings delivered across town to his apartment on Fifth Avenue. Well, this prompted some investigations, and I was I was the specialist in this thing, and all of a sudden some floor brokers came in breathless, and they were trying to sell deep in the money call options, 1,000 at a time. Now, I was long a lot of stock. I think I was long something like 2 million shares of the stock. It was like $110 stock at the time. So now this is all with leverage, by the way. It's market makers are using a lot of bank balance sheet. We were using Goldman's balance sheet at the time. So but I had in total, I probably had about $1 billion worth of equities in the portfolio at the time, and most of that was Tyco. And they just, with whatever bid I made, they would hit it. And I was, at the time, I was just lapping it up because I was thinking, oh boy, I'm buying these things so cheaply. And I would just I had a wire into the Tyco pit on the big board. And in those days, you could still trade big blocks of stock on the New York Stock Exchange. It's not true anymore. You basically have to go find these trades. The specialist on the New York isn't committing huge amounts of capital. But at the time, I could actually pick up the phone and say, sell 100,000 Tyco. So that's a big chunk of stock, saying sell 10 million, sell 10 million, sell 10 million. And I remember all of a sudden there was a trader behind me who worked for another specialist unit called Cohen, Duffy, McGowan. And I just heard him. I heard Tommy say, something's not right. And I remember thinking, yeah, absolutely. Actually, something isn't right. Why are they doing this? Why are they all of a sudden selling all of these deep calls to me? And somebody's trying to hit my bid, and I thought, whoa. So you know what? Hold on a second. I just picked up the phone. I said, sell 250,000 Tyco, and hung up the phone. And right then, the stock halted. And
oh my God,
what just happened? What just happened? Well, what just happened was a guy who ran something called the Prudent Bear Fund in Texas, a guy named David Tice, had put out a note. He was kind of like the Muddy Waters of his day, of that time. He had put out a note saying there's accounting irregularities at Tyco. And people knew about it before I knew about it. And all of that flow was people who couldn't hit downticks because at that time they had an uptick rule on the listed stocks. So they were using these deep call options to basically get short the stock synthetically. And I wasn't really thinking about that. I was just being greedy, just thinking I was picking up all this free money. And I remember sitting there for what felt like an eternity staring at the light, because the wires in those days, you had a button and it only went to one place. So I had a button that only went to the Tyco specialist on the big board. And I waited and I waited and I waited, and the light rang. I pick up the phone, and the guy that represented me in that pit said, Mike, I'm really sorry. And I was thinking, oh my God, he didn't sell the stock.
Oh my God.
250,000 shares. So it's $25 million worth of it. And he says, I'm really sorry. I had to sell it down 2 points. And I said, God bless you. Because I literally thought I was long in excess $25 million worth. And we were going to wake up the next day and the stock was going to be down 30%, which probably was a number, something like that. So, I lost $500,000 relative to where I thought the stock was trading by hitting the bid. I'd given him the order not held, but the stock was down, double digits the next day. So it would have been, millions. So that was a big one. And interestingly, you would think you would learn your lesson, but I had another similar experience many, many years later. Now I was at Cantor Fitzgerald, and somebody calls me up and says, can you make a market in the UNG, that's the US Natural Gas Fund, October 14 puts? And I can still remember the market I made because of how this trade turned out. And I said, I'm 250, 265, 5,000 up. So that means I would buy 5,000 of those October 14 puts at 2.5, sell 5,000 at 265. And the sales trader said, I can't do anything with that. I need some size. Well, 5,000 options is pretty good. That's 500,000 shares of the underlying. So I thought I was making a good sized market. So I said, all right, well, we'll go 240.85, 25,000. So 2.5 million shares now. What do you want to do? And he's like, I can't show it in. And I said, you can't show that in. I said, what are you talking about? 2.5 million shares, and that's not big enough that you can even contemplate trading. So I said, what kind of size do you need? And he said to me, what's the position limit? I said, geez. I said, I think 250,000 contracts, maybe. And I said, first of all, I'm out of my offer. Because at this point, I now know no one's going to sell me 250,000 puts. So something's going on. So I said 250,000. He said, where can you show me an offer on 250,000 puts? I said, I can't. I said, I don't have the capital to do that. I'd have to call Howard Lutnick, and Howard Lutnick will never say yes. So that's not going to happen. So we were at a little bit of an impasse, and I said, if I showed you an offer on 100,000, would you show it in? Would you show your guy? And he said, yes. So I said, let me call you back. And I kind of noodled on it for a little while. And I said, where would I sell 100,000 if I could? I didn't have the capital to do it, but I said, where would I be willing to sell it? Now, at the time, UNG was trading around 1565. And you're going to have to bear with my memory because this is about 12 years ago. But I think it was about 1565 at the time I made my market. And I said, I'll show you 100,000 at $3.45 a contract. And my logic at the time was I could find other banks, I could find other market makers, I could call Susquehanna, I could call Citadel, I could call all of those guys, and they'd step in because I was making such a juicy price on these things. And so he says, okay, he shows it in, and he comes back to me, he says, I'll buy him. 345 for however many you will sell.
He must have knew something.
So, well, we bought 45,000 puts street side and then printed another 100 at 345, meaning that we were lifting them off the screens, and then we sold, basically at the high price. And I used to be a market maker, among other things, on the New York Mercantile Exchange, trading natural gas options on the futures. And the biggest trader at that time was a guy named, well, I won't mention his name because maybe he doesn't want his name mentioned. He worked for Don Wilson. It's a big trading shop in Chicago. And I called him at the end of the day and I said, we got something big going on in here and I think you're going to care. Can you meet me at Brasserie for a beer? And he did. So after the close, we met at Brasserie in the Seagram's building and said, we've got all of this stuff going on. Are you interested? And he said, oh my God, I absolutely want to trade this. He went home for the weekend. Monday, I called him up. Are you ready to trade these? And he said, not yet, because he was trading the futures. He had to set up an account. And then Tuesday morning, he said, all right, Mike, I'm ready. Let's go. I'll buy 100,000 same way. I said, buy? That doesn't make any sense. You're supposed to want to sell these things. So I suddenly realized once again, greed had gotten the better of me. And I was looking at the amount of edge that I saw in these without thinking about why. What was going on? Well, it turned out that the customer of our sales trader in Dallas, and that should have been my warning sign, he was in Dallas, never take an oil or an energy trade out of Texas, because by the time it gets to you in New York, everybody who knows anything has already picked over it. The buyer of those puts was John Arnold. probably the most successful natural gas trader in history. He's the guy that ended up putting Brian Hunter and Amaranth out of business. And he had already hit his position limits. He was short natural gas swaps. He was short natural gas futures. He had bought natural gas futures puts. He had bought every bearish trade in natural gas that you possibly could and hit his position limits. And the only reason he was trading the ETF was because that's all that was left. And the guys on the NYMEX were crying uncle. Now, what John Arnold knew was that people like Aubrey McClendon at Chesapeake were taking so much natural gas out of the ground as a result of fracking that the market was going to collapse. They were going to be flaring natural gas. And I had been away from the natural gas markets long enough that I wasn't really paying as much attention to it as I used to when I traded it. And I was looking at it only from a vol perspective and thinking, I'm making 30, 40 clicks a vol on this. UNG went hard to borrow 2 days later.
Oh my God.
And I started selling natural gas futures. And I got phone calls from Howard Lutnick's office. What are you doing? And I said, it's the only way I can get short natural gas. I got to be short natural gas. So yeah, I think, the biggest lessons we learn, you sometimes have to learn them more than once.
Yeah. So that's, and that's what I want to kind of leave everybody off here with it, because, we all make mistakes, Michael. And obviously nobody's at your level. I was a market maker too. And I just always know, listen, they try to be your friend, but it's all about winners and losers, right? They're all trying to, someone's got to win, someone's got to lose. And if they can find a sucker in it, they're going to do it. But how could everyone here not, obviously not that level? What should they be cautious of if they are going to trade an option? Listen, you and I have been through the financial crisis, the internet bubble. A lot of people here just being new, just getting through COVID. We never expected that. And it was, some of those biggest catastrophes make opportunities. What should they look for moving forward? Now we're through the election, and we're seeing what's happened. We had this big Trump rally. What should they focus on, and what should they be real careful of that you probably would recommend them? You're on TV all the time. They're always asking for your experience. What do you think?
Yeah, first of all, when I'm on CNBC, usually they have something they want to talk about, and they're just looking for the flow in it, which is very different than what I spend my time doing from one day to the next. What I'm interested in, and what you guys are all interested in, is trying to find trade opportunities, not trying to find the story of the day and then looking to see what happened in that story.
Right.
Because oftentimes, by the time it is the story, it's over. If you often are watching the financial news and you kind of feel like, God, how are they talking about this now? Shouldn't they have been talking about this yesterday or 3 days ago or 3 weeks ago when, there was still something to be done? So I would say that one of the things you want to look out for right now are crowded trades. When you see really crowded trades, and this is, when momentum turns, those downside reversals, which, when we were on the floor of the New York Mercantile Exchange, I don't care what the underlying asset is. Nothing scares me more in a bull market than seeing something gap open to all-time highs and close lower. Mm-hmm. It doesn't matter whether it was natural gas, whether it was crude, whether it was the oil service index, which is what I traded before there were ETFs on that same thing, or any individual stock or the market. Those are the things I worry about. In the option space, where you will see this typically is in the relationship between options prices on single stocks, like the constituents of the S&P 500, and usually I'm only talking about the top ones, like the top 50, because the bottom ones, they don't really have such an impact on it. When the implied volatility, the price of options on the index gets very, very low relative to the implied volatility on all of those single stocks, that is something to be concerned about. And it happens, there's sort of a functional reason why this is going on. First of all, passive investing has just become the theme. People put their money into IRAs, 401ks, ETFs. There's much less discretion being made in investing. It's just a thematic and a secular trend. One of the things that has happened is that people had, especially when interest rates were very low, looked for other sources of yield. And that included trying to sell optionality, selling options on the indices. And that seems safer most of the time. And it usually is, because index options volatility historically had a larger gap with realized volatility, because the indexes indices had benefits. And their biggest benefit was one of diversification. So if you sell puts on a name like Tyco in 2000 or in a name like NVIDIA today, and suddenly something bad happens, you can lose a lot. Whereas selling puts on an index, you have the crash in 87, you have the flash crash, you have a couple isolated cases like this where the thing really moves a lot. But in general, you can usually absorb that. Well, the problem is when that relationship gets a little bit too distorted, and it did exactly that this year. Earlier this year, the relationship was such that the implied correlation for all of the constituent stocks in the index was zero. And I mentioned this when we were at the thing in Miami. Someone said to me, what's the biggest mistake that institutions made? And I said, correlation isn't zero for equities. It can be zero for a period. One stock goes up, the other one goes down, a whole bunch of stocks go up, the other ones go down, index does nothing. But that doesn't last. It never, ever lasts. There is always a moment when correlation shoots up. And if it's very low now, what that means is that the price of downside insurance on the index is too cheap. And I think we're getting very close to that. And at the very least, look, you can buy 2% out of the money protection on the S&P right now for less than 1% of the index out to January. What the hell? It was like, just go to the end of January, wait for the inauguration. Do I know how everyone's going to respond to it? Look, the Trump trade momentum is all great, right? But is it going to last until the end of January? I don't know. Am I willing to spend 80 basis points to get a 2% out of the money put on the S&P against my long equities? Come on. It's a no-brainer. Let yourself sleep. Enjoy your Christmas, for crying out loud.
Yeah. Well, you know what, Mike, thank you so much for being here. And it's been an honor.
See if I get this green. All right. Okay, hope you guys can see it.
Yep, everything